Welcome back. You're still watching London Eye. I've been in conversation with Edward Evans of Ashmore Investment Management. What's the biggest risk to your emerging market thesis right now? That things are constructive, you're in a 5-year good space with the EMs. What do you worry most about?
Developed world, developed markets. I'm afraid it's problems in developed markets causing volatility in emerging markets. I mean, year to date, you've really had all the tail risks in a way coming to the fore, right? So you've had the sort of increased protectionism around trade and potential ramifications around that. Our base case, at least, is actually the chances of that, or the probability of that escalating to a global trade war, if you will, actually seems pretty low likelihood. The world's become very complex. Global supply chains are very much integrated, so it's very difficult to pinpoint and cherry pick off tariffs across industries. Instead, I think if you think of US's main trade partners, it comes down to your Mexico, Canada, China, of course, Japan and Germany. And if you look through that list, then the NAFTA negotiations are clearly progressing, which I think in a way point to a pragmatic approach from the US authorities. Japan is a key ally in Asia for China, as a big pardon, for the US, and somewhere like Germany clearly has the support of the EU. So that really leaves China as the standalone. So it becomes more of a bilateral trade negotiation between the two. Now that hasn't gone that hasn't gone away, and I expect that volatility to keep coming back. But overall, you're sort of ascribing a low probability to an escalation in a trade tariff war. I think it would be very pinpointed between those countries. I can't help but think in the US's case, they've perhaps got more than half an eye on the forthcoming midterm elections and positive newsreel ahead of that. And there's sufficient pragmatic steps in place to prevent any escalation.
Is that the only issue relating to the developed world that worries you, or do you worry about the bond yield inflation scenario, which a lot of people seem to be quite worried about in the US?
Yes, yeah. The focus from the Federal Reserve on tightening, and indeed the Eurozone, which will increasingly is starting this step, this sort of policy normalization, if you want to call that, is, to my mind, very much focused on improving the toolbox for future use. Okay, developed markets put in place exceptional monetary policy since the financial crisis, and they're unwinding that as carefully as they can without forming de-escalation to economies or de-escalation to stock markets. I think that in the US's case, they're communicating very loudly and clearly their path of normalization. And of course, markets will sometimes be slightly ahead and slightly behind, so you have adjustment periods. But without there being significant inflationary pressure coming through, then this is in turn pointing to actually quite a benign global growth environment from the US. And if the US is growing nicely, if the Eurozone is growing nicely as it is, then all around that points to a favourable context for emerging market companies to operate in.
If all this is true, why do you get the sense that investors appear more skittish this year? I mean, small things spark off large bouts of volatility compared to last year where, you would get a 2% correction and markets would come back to new highs very easily. This year, there seems to be an edge of nervousness. Why would you say that is palpable?
I think that's probably driven by technicals to some extent. So investors repositioned themselves last year. They benefited, as we see with hindsight, from a very strong period of returns and low volatility. And now there's a situation where investors sort of take profits, readjust their portfolios as they see fit to reflect the fundamentals. I think emerging markets have been pushed to and fro by this, but I think that's an opportunity for investors to pick up exposure within emerging markets at quite healthy valuations.
That's what you're doing, buying any significant dip that you're getting?
Not any dip, but we're certainly taking advantage of the periods of volatility, yes.
I want to ask you about politics in India a bit, because we are heading towards an important election. We're already going through many state elections. As an investor, a significant investor, how important is that, you think?
I think elections and let's call it politics or political noise in India is only going to get more important, and I think it's going to be a source of volatility in India as we head towards them in 2019. Taking a few steps back, the policies themselves inherently seem to be actually not that divisive across the political spectrum in India. So whilst this could be a source of volatility, the actually impact on, let's say, fundamentals, which ultimately drive stock prices over the long run, seem perhaps less important. But it is clearly something that the market's going to watch increasingly closely. As you have a series of local elections between now and then, the results, the reaction from Modi's government will clearly be a point of focus by the market.
Coming back to the earnings cycle in emerging markets, how confident are you that we'll get a full-fledged capex cycle as well once corporates start seeing earnings flow in? Because that's really the sweet spot where investments also kick in and you get a much more prolonged and a sweet cycle. Are you getting the sense that that kind of confidence has returned, or you don't get, I mean, are investors more optimistic than the companies themselves?
No, I think that's a good question. I think from a company perspective, there are signs of that coming through, but let's not forget we're still, I think, almost in an earlier phase. We're still in a sort of a recovery, a stabilisation phase after multiple years of negative expectations and, quite frankly, quite poor corporate discipline. Emerging markets had it pretty easy prior to the financial crisis. I think it's taken them longer than you'd hope as an investor to acclimatise to this new low global growth for longer backdrop, and hence there's been a focus by corporates on managing tighter ships, greater cost discipline, capital allocation discipline, which we've very much seen sort of coming through last year and continuing this year. I think the next step, to your point, is the corporates starting to invest more proactively, which I'm confident of.
So where are we in the earnings cycle now? Because that's the big one. Last couple of years we've got some earnings growth, but not quite the 20% plus earnings growth, which leads to big P multiple expansions. Do you think it's a matter of time before that will happen, or is this going to be a slightly more anemic kind of an earnings growth cycle?
Well, taking the MSCI Emerging Market Index, earnings growth was around the mid-20s last year. And of course you had the stock market up almost 30%, so it essentially supported that earnings trajectory as we went through the year. So it meant at the beginning of 2017 you're asked to pay 12 times next year's earnings. At the end of 2017 you're asked to pay 12 times next year's earnings. So from a valuation perspective it was an exceptional period. It remained very benign. Moving into 2018, the year started very strongly, valuations got pushed up, it was becoming, I think, more stretched, there were signs, but then you've seen earnings come through and expectations sort of stabilise, and in local currency terms, these expectations are continuing to be met, and in many cases beaten. So it is really a case of following the money to give you that sort of reassurance that that outlook in emerging markets will continue.
A question about geopolitics. Do you think things are slowly on the mend, or do this recent salvo between that US has fired on Iran destabilizes matters once again?
It's never straightforward. As quickly as one thinks that the geopolitics are improving, the dynamics change again. Nobody has any greater insight on those areas, so it's not, you don't base investment decisions on geopolitics. Of course you're wary about how the changes could have ramifications, but it's not something you can make a fundamental based decision on.
So if you were running a large GEM portfolio today, what would be your top 4 overweights and top 3 underweights, country-wise?
Country-wise, global emerging markets, yeah. Well, if I look at our portfolio, areas that we favour the most, we don't allocate by country. It's rather looking top-down at country and then through country at industry groups in countries. So the areas we favour a lot, for example, are the semiconductor space, which points to an overweight in South Korea and Taiwan, which has been performing very well. We are underweight India as a whole on aggregate, but we have a good exposure in a well-run private bank, and indeed have added to a public bank earlier this year. So it is India is a country that we'd look to opportunistically take advantage of volatility to add exposure to, albeit selectively.
Are you still hopeful that despite the volatility of the first half of the year, we could actually eke out some gains by the time the year is out for EM equities?
For emerging market equities, yes, I think so. I mean, I think it's interesting that, I mean, despite, quite frankly, all the tail risks coming to the fore seemingly this, year-to-date period, emerging markets are essentially flat over the period. Net flows at the industry level have continued generally to tick in. Earnings growth expectations remain strong and very broad-based by country and industry group, and those expectations are being met. So I think in a way the biggest risk out there is that investors get blindsided by the global tail risks and miss following the fundamentals of emerging markets, which remain very constructive.
Edward, a pleasure. Thank you very much for your time.
My pleasure. Thanks.